Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Much like the bomb squad that comes onto the field late in the game and has a massive impact for the Springboks while really irritating Northern Hemisphere rugby podcasters, companies are frequently a tale of two halves. A disappointing first half can be turned into a decent full-year result when the fresh muscles arrive on the field, provided there are really good reasons to believe that the finish to the year can be stronger. Companies often talk about hoping for a better second half, and hope is absolutely not a strategy, as the old story goes. There need to be plausible, believable, real reasons why things are going to get better. Two solid mid-cap companies on the local market gave us updates in the past week that point to a potentially strong finish to the year. Will these prove to be bomb squad stocks? Time will tell. Let's dig in. Afrimat feels like a great place to start. The company is a regular pick among SA Inc. enthusiasts. With a market cap above 10 billion rand, it's big enough to be an institutional option as well because there is liquidity. This already helps the valuation avoid the pain that so many small caps and even mid caps experience, where there just never seems to be a value unlock because illiquidity gets in the way. Afrimat is firmly part of the so-called real economy, with businesses that benefit from people wearing hard hats and driving yellow machinery around while building things. With a focus on construction materials and industrial minerals, they aren't quite the shovel in the gold rush, but they are what the shovels get shoved into when building roads and bridges, along with other interesting opportunities like bulk commodities to local and international markets, and even phosphates to the agricultural sector. The real trick at Afrimat is that the company has done a terrific job over the years of making strong acquisitions. They are very proud of this, and they always include a chart showing HEPS with and without the various acquisitions over the years. If you're good at something, you need to make sure the market knows it. This is why there has been strong support for the Lafarge acquisition despite it being a risky deal. Afrimat is very good at turning around underperforming companies, and the South African Lafarge business is firmly in that category, with losses for the first half of the year. Believing in the Lafarge turnaround is one source of a potentially better second half. This brings us to a discussion on why the first half wasn't great. Now, we don't know yet how HEPS did, but the company has told the market that volumes will decline for the 6 months to August. The first quarter was the biggest issue, with local volumes plummeting thanks to problems at ArcelorMittal as a major customer of Afrimat. Now, this is one thing to be aware of with Afrimat because ArcelorMittal is under extreme pressure at the moment. Interestingly, Afrimat expects things to get better there for the rest of the year, but this is by no means guaranteed. So, a better second half for Lafarge? Believable. A better second half for ArcelorMittal as a major customer? Maybe, but that does sound less likely. How about a stronger second half for infrastructure investment in South Africa? Afrimat has highlighted that the June to first week of August period saw better tender activity in infrastructure projects. So there's the post-GNU story coming through. Afrimat's share price is flat year to date, trading at around 64 Rand at time of recording. The 52-week high is 75 Rand and the 52-week low is just under 48. So a bit of a coin toss right now and perhaps some more downward momentum in that price before things turn because it has been dropping recently off the highs. But this is one for the watch list. We now move on to the JSE, or just JSE, but it kind of sounds weird to say that, right? We always say the JSE. You see, JSE Ltd, the company, is listed on the JSE, i.e. its own product. This is always a bit of a mind-blowing thing for market newbies to learn. With a market cap of just over 9 billion rand, JSE Ltd is a fairly similar size to Afrimat. Trading on a dividend yield of 7.4%, the market doesn't give JSE Ltd much credit for growth. The JSE itself is seen as a bit of a cash cow, although I'll never understand investors who only chase yield unless those yields are close to total required returns, i.e. running in the teens. JSE Ltd has only managed 3% share price growth in total over 3 years. That kind of underperformance is not fixed by a dividend yield. Still, the company has benefited from the GNU exuberance and is up 14% year to date, which is certainly more than we can say for Afrimat. That's pretty interesting. And at 105 Rand per share, JSE Ltd is trading close to the 52-week high of 110 and way above its 52-week low of 80. Things need to get better in the second half for them, which is why I'm including the stock here. For the first 6 months, revenue was up by a rather sad 4.3%, especially when expenses were up by 6.4%, which means margins went the wrong way. EBITDA margin fell by 200 basis points. At a 42% margin, it is still a lucrative business, but of course you never want to see margins heading in the wrong direction. In the results, CEO Leila Fourie made the point that the value traded in the equity market recovered in the second quarter. Anyone who has been watching the GN euphoria on the local market could have guessed that. The trend continued into July, which is encouraging. Goodness knows they need it to continue because headline earnings per share was down 0.2% year on year for the interim period. Non-trading activity is only 38.6% of revenue. The company has done a lot of work to get that number higher, but they are still primarily exposed to the levels of local trade and investor interest in our market. Seeing some foreign inflows would certainly move the dial, for example. A risk to keep in mind here is that the company earns net interest income as they need to keep loads of regulatory capital on their balance sheet, which they then invest in yielding assets like government bonds and other sources of yield. Unlike most companies, a decrease in interest rates would actually be a negative for them in terms of finance income. One would have to hope that the resultant uptick in activity on the market from lower rates would help offset this. And of course, the value of those government bond investments going up as well certainly wouldn't hurt. So, which would I pick? It's always good to remember that share prices behave differently to earnings. Earnings are backward-looking and share prices are forward-looking. JSE Ltd has had a very strong year thus far for investors and is close to its 52-week highs. Afrimat has come off the boil since the best of the GN euphoria. Over 5 years, Afrimat has returned over 91%, excluding dividends. JSE Ltd, that's down 14%, also excluding dividends. This, combined with where the two prices are trading relative to recent highs, would be a major contributor to my pick of Afrimat out of the two for the rest of the year. I would also pick Afrimat as my long-term choice, especially as we head towards lower interest rates that should have a negative impact on earnings over at the JSE. My worry is that if equity volumes don't come through as expected in the second half, JSE Ltd could re-rate to a higher dividend yield and thus a lower share price, as the market takes a view on disappointing growth. As for Afrimat, there are a few things that can go right for them, with the joy of operating leverage just waiting in the wings to come through as revenue picks up, with ArcelorMittal as perhaps the biggest risk there, as I mentioned. Let's see what happens. For me, out of the two, I would pick Afrimat. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.